All right, today we're going to do something a little different. We're going to perform an autopsy, basically, on a speculative frenzy. We're going to dive deep into the data behind one stock's absolutely wild journey, a company called Nuburu. Because really, this is the perfect case study in high-risk, high-reward trading. It's a story packed with extreme volatility, just massive speculation, and a whole bunch of data that's flashing some serious warning signs. Okay, let's get into it. So, first things first, we've got to understand the setup. I mean, the sheer chaos of this stock's price action that made everybody turn their heads in the first place. Just take a look at this timeline. Over only 3 months, Nuburu's stock has been on an absolute roller coaster. In July, it's trading way up near 35 cents. Then by August, it completely collapses, down to just 12 cents. And then it stages this crazy recovery, climbing all the way back to 22 cents in October. I mean, this kind of swing is the real puzzle we're trying to solve. What on earth is driving this thing? Well, that brings us right to the catalyst. You know, if the price is the engine, then the trading volume, that's the fuel. And in this case, it looks like someone poured jet fuel on the fire. Now, check out the scale on this. Back in July, the stock was trading, on average, about 5 million shares a day. Okay, pretty normal. But in October, during one of its big surges, that number just exploded to nearly 800 million shares in a single day. That's not just interest, folks. That's a massive signal of intense, widespread speculation. That's what's powering this whole move. But you know, when you're burning that much fuel that fast, you've got to start looking at the dashboard for warning lights. And right now, the technical indicators, they are telling a very tense story. Okay, before we check out that dashboard, let's make sure we're on the same page with a key term you're about to see a lot: overbought. The best way to think of it is like a sprinter who's been running at top speed for way too long. They just can't keep that pace up forever, right? An overbought stock has gone up so far, so fast, that a pullback, or at least a cool-down period, is statistically pretty likely. And this dashboard just lays it all out perfectly. We've got our gauges for momentum, trend, volatility, and volume, and pretty much all of them are in the red. The momentum indicators are literally screaming, extremely overbought. The volatility bands are showing the price is way overextended. And here's the kicker. Even though the price is surging, the trend indicator is suggesting the underlying trend is actually pretty weak. So what this tells us is that while the stock looks strong on the surface, the mechanics underneath are showing some major signs of exhaustion. And to put an even finer point on it, a statistical analysis, which basically predicts a price based on its past behavior, suggests the stock should be trading around 11 cents. Right now, it's trading over 111% higher than that. That is a massive deviation from the norm, and it just hammers home the idea that this stock is in extreme and maybe unsustainable territory. So all of this tension, all of these warning signs, it brings us to the climax of our story. The stock is sitting at a critical fork in the road, and something's got to give. This right here is the battleground. On one side, you've got the floor, what we call key support, at 19 cents. If the price starts to fall, this is the line in the sand that the buyers need to defend. On the other side, you have the ceiling, or key resistance, at 33 cents. This is the wall the price has to smash through to keep climbing. The stock's next big move, it's going to be decided right here, between this floor and this ceiling. So this really leaves us with 3 potential paths forward. First, you've got the bullish path. It breaks through that 33-cent ceiling, and all that speculative momentum just keeps on rolling. Then there's the neutral path. It gets stuck in the mud, bouncing between 19 and 22 cents as buyers and sellers just battle it out for control. And finally, the bearish scenario. It fails to hold that 19-cent floor, which could lead to a really sharp drop as traders decide to take their profits and get out. So, where's the resolution? What's the final takeaway when you put all these puzzle pieces together? Well, the conclusion from the data is pretty clear. Yes, the stock is technically in a strong short-term uptrend, but, and this is a big but, it's being fueled almost entirely by speculation, not by company fundamentals. Those overbought signals are a huge red flag that this run could be running out of gas. High volatility is pretty much a guarantee, and the main message for anyone watching this is to be extremely cautious. This is the textbook definition of a high-risk, high-reward play. And that leaves us with one last really fascinating question, doesn't it? All the data we've looked at, it all screams caution. The warning lights are flashing all over the dashboard, and yet hundreds of millions of shares are flying back and forth. It really makes you wonder, in a world that's driven by data, What is it about our own psychology that drives a crowd to bet against the numbers?